Let's first look at inventory estimation. So as we just talked about, if the firm is using a periodic inventory system, they need to go ahead and do a physical count at the end of the financial reporting period in order to determine what is their cost of goods sold and cost of the ending inventory. So the periodic inventory system relies on the firm's ability to determine the ending inventory value at period end. However, sometimes it's impossible or infeasible to determine the ending inventory value. One example is, so for example, firm B keeps track of the unit purchased, but it does not keep track of the units sold. And suddenly there's a fire happened during the period and it destroyed everything. So, so under this situation, how can company determine the cost of the inventory sold? So please take a minute, think about what is the problem here. If the firm is using a periodic inventory system, what is the problem here? So supposedly, if this fire, we don't know how much inventory this fire has destroyed. Supposedly, after the fire, nothing is left. So if you go ahead to do a physical count after the fire, you are going to find nothing. No matter how many units you have sold, you are going to find nothing. So the problem here is you just do not know what is the number of inventory that has been destroyed in the fire versus what is the number of inventory that has been sold. So you could have just sold one unit and 99, all of the 99 other units are destroyed in the fire. Or you may have sold 99 units and only one unit was destroyed in the fire. You cannot distinguish between these two after the fact, after this fire. So this is a problem here. So if there's something like this happening, the firm just through a physical count, the firm will not know what is the unit that has been sold. So this is one possible situation that may cause a problem under the periodic inventory system. And another example is some of the firms, like those retail firms. So for example, firm B is a large retail firm. It takes a physical count once a year because physical count is very costly for this kind of firms. And then, however, firm B's bank asks for monthly financial statement as a condition attached to a loan. So in order to obtain loan from this bank, firm B needs to provide the bank monthly financial statement. And on its monthly financial statement, the firm B needs to state what is the cost of my ending inventory on its financial statement. So how can B avoid the costly procedure of counting inventory at the end of each month to determine the cost of goods sold and cost of the ending inventory? So this is another problem that firms may have if they're using periodic inventory system. So in those two situations, what we do is, in order to go ahead to have a physical count, the firm may just do a inventory estimation. They may estimate the inventory cost, or in other words, they estimate what is their cost of goods sold and cost of the ending inventory without a physical count. So how can firms do that? There are two ways the firms can do that. One is called the gross profit method, and the other is called retail inventory method. And in simple words, what's the difference between these two methods? So if you still remember the formula we talked about last class, we have the cost of the beginning inventory plus purchase minus cost of goods sold equals to the cost of ending inventory. So under the gross profit method, the firm just go ahead to estimate the cost of goods sold directly, and they through the cost of goods sold, they are going to get an estimation of the cost of the ending inventory. So this is the gross profit method. Versus under the retail inventory method, through some ways, the firm is going to estimate the cost of its ending inventory. And after they know that number, they're going to estimate what is their cost of goods sold. So let's just briefly talk about these two methods, and then we're going into each of those in detail. Under the gross profit method, so basically, in order to estimate the cost of goods sold, the firm take the net sales minus multiplied by 1 minus gross profit ratio. So it is basically based on gross profit ratio, which is a usually a historic number. However, this method, it is not accepted for preparation of annual financial statement. So on the firm's annual financial statement, the firm cannot use this method. And the retail inventory method, instead of based on gross profit ratio, the firm is going to calculate something called cost to retail percentage. And then the firm estimate cost of the ending inventory, which is this number, based on the selling price of the ending inventory, multiplied by the cost to retail percentage. And then this number, it can be used for financial reporting and income tax purpose. But under this method, the firm must maintain record of inventory and purchase, not only at cost, but also at current selling price. So this is a brief explanation of the difference between these two methods. And then we're going to look at each of those in detail.